Okay, hello everyone. It's 2 p.m. in Geneva, and today we are starting our live stream, and we are starting our live masterclass dedicated to trade credit risk outsourcing. Whatever questions you have, put them. Unfortunately, this format does not presume live discussion, but we will do sooner or later, we will do a Q&A stream. Just put in comments if you want it, if you have your questions. Let's start. Let me start with my presentation. So first of all, we need to justify a little bit why we speak today about trade credit risk. In general, this is our little research we found made in our practice in credit engineering that significant part of companies, if you can look on the x-axis, you can see number of businesses, and then you can see the percent of result delivered by one of the three, but by each of the three trade credit management stages. We're speaking about collection, control, and we're speaking about structuring. And as you can see, structuring, again, you might have your own view on that, but based on our views, based on my personal experience in credit management, and I got quarter century plus something in this area, I can tell you that structuring, I will explain what does it mean. Structuring is actually the finding optimal terms of credit for the customer. This has an impact that it delivers more than half of the result in credit management. But at the same time, 80% of companies, and this is our restrictive estimation, restricted assessment, mostly concentrated on collection and control, which are delivering nothing more than half of result. So as I used to say, in very general, quite generous view, the biggest one of the biggest stereotypes in business is that there is a magician who will come and collect everything. So, and at the same time, everyone who knows how to collect or who collected him or herself, at least once, they know that not every debt is collectible. There are bad debts. There are situations where collection is very, very restricted and customers not just reluctant to pay. To simplify this, we can also say that it's collecting money from one who has it. There is no is really question of technique. Is really technical question, quite simple one, but at the same time, collecting money from someone who doesn't have the money, like we are speaking about bankrupt, or we are speaking about personally insolvent person, and so on and so forth. This is really a problem, and it's very far from the idea that somebody can come and just use his or her interpersonal skills and convince that person to pay. No, it not always works. So the thing is, the main part of credit management, and really an art of credit management, is to find terms which would be appropriate to every situation and obviously updating them. So that's why we believe that trade credit risk and working with trade credit risk is really important for businesses. What traditional sources, as promised, we will make a bit of overview for existing what current market proposes in terms of outsourcing of the credit risk and in general credit management outsourcing. But before I start with that, I need to draw your attention to a simple thing that outsourcing is not something exceptional. We all in our life use outsourcing. Our children go to school. We don't educate them ourselves. When we need a support from a specialist, I don't wish either of us to go to doctor or to lawyer, but when we need a specialist, we go to specialist. And by the way, when we got a headache, we don't go to the when we got headache, we don't go to the gastroenterologist. We go to the specific specialist who is taking care of stomach or a head or eyes or dentist or whatever. So we always keen to find real specialists who will solve our problem, and we use by the means of our life, we used to use outsourcing. And furthermore, if we look at the company, we understand that all the personnel of the company is actually outsourcing. Okay, they don't work for somebody else, but they are not the company. Okay, this might be debatable, but anyway, we all use outsourcing. So in terms of credit management, most traditional thing is collection services. So when we don't have time or there is something else, there are companies who got more knowledge, more personnel, and so on and so forth. There might be different reasons for that, but quite common is to use debt recovery or cash collection agency as an outsourcing partner, especially when it comes down to financial service businesses. Another very common example is credit report. Well, they exist more than 100, correct me if I'm wrong, but for sure they exist for more than 120 years. Started with DNB agency, and now we got lots of agencies who provide credit reports. Again, credit report is something is actually combined information about the company, which helps us to take grounded and mindful credit decisions, sound credit decisions. Credit insurance generally does the same job. First of all, credit insurance providers do provide credit reports. This is not something like I'm not opening in America or discovering America, or that I'm not trying to make news. Credit insurance also provides an assessment. For instance, quite simple thing is when you apply, when you come with a request to your to your credit insurance, insurers or underwriters tell you whether or not they are ready to grant a limit on this or that specific counterpart, which is already an assessment because they're ready to underwrite it. So if the insurers give credit limit, okay, you can say that this customer or this supplier or whoever is actually of good financial health, because there is an assessment from credit insurance and there is a limit. Another story that credit insurers, and to the extent it is known to me, never say why the limit is so. And then, okay, if you rely only on credit insurance, this might be a tricky situation for you because technically speaking, you outsource your decision about credit to a credit insurance company. You're completely relying on the credit insurance. I don't say this is good or bad. The question is whether or not you are ready to that. And another important moment, that if you need to go above credit limit, do you know, or does your company know how to deal with unsecured credit, what to do, and many other questions. Again, nobody say it is good or bad. We are talking about facts, and in credit engineering, we've got quite simple principle. We should use every tool with the clear understanding of their properties, of its properties. There are no good or bad. Nothing is good or bad. We just work with it as an instrument. Payment allocation and other tasks which could be given to either outsourcing partners or also software as a service providers. Payment allocation could be automated. Again, you decide whether or not the quality of that instrument is good for you, for your business, for your results, but this is the way. And factoring. I will just touch that slightly because there are lots of things to discuss. It's just like a very big area. We can dedicate another webinar on factoring and on trade credit security. But maybe factoring is the only service which could look like complete credit function, because generally speaking, factoring may solve three general problems. So they take credit risk, they provide finance, and they do collect. However, again, the same story as with credit insurance. Whether or not you are ready that somebody sets credit limits on your trade based on their idea or based on how they see credit risk and how much risk they are ready to take, because this is their risk, this is not your risk, and this is their business, not your business. Again, decision is always yours, but we will speak in the end about what is possible to outsource, what is not possible to outsource. I will keep it as a rule of thumb, little bit later on. Okay, so as you can see, there are lots of services, but this is our decision what to put in on what to connect with our credit function, and especially when it comes down to trade credit decisions. I don't believe it is necessary to repeat that even risk assessment itself is not a decision, and although it is very important stage in credit management, but main thing, and it's I was writing about that short post on LinkedIn saying that credit decision, risk assessment and credit decision are two different stages of the credit process. We first assess credit risk, then we decide what to do with it. And much more important, risk assessment itself is not a virtue, is not a thing which somehow helping us unless it is included into the terms of credit for our customer or a supplier. Otherwise, it's just useless. Good example for that, my favorite one was given by Professor Altman. He provides an idea that there were so many signs of Enron to fail in some future time, but neither of creditors, either trade or financials, withdraw their facility or change their terms. So if our risk assessment is not reflected in the terms, it's just useless. It's waste of the time. It wasted time, wasted efforts, wasted money. In the end of the day, it's just unnecessary expense. This is it. So, what is our view in the holistic credit management methodology? We come to terms in a simple way. We compare credit worthiness with credit demand. We reflect credit worthiness in money, just like we define credit worthiness as an amount of money which could be trusted to this or that counterpart without any additional security. Like how much it is safe to trust to a customer, then we compare it with the credit demand, which is defined as amount of money necessary for the transaction to happen. It's focused at receivables, if in more simple terms. So how much credit is needed, how much credit is safe, and then there is a difference. And thanks to that comparison, we can make credit risk visible. And then we just decide, every creditor decides what to do with that credit risk. Quite simple. If the credit worthiness of a customer is $1 million and the credit demand or amount of credit required for the transaction would be 100,000, the decision is pretty obvious. We simply grant credit and this is it. But then if the situation is opposite, when the credit worthiness is 100,000 and the credit demand is 1 million, then we got enough to think. And we obviously can put the credit limit. So the limit, we can limit the risk we are happy to take, happy to accept, either on the level of credit worthiness, which would be, we just reject credit risk as a first approach to credit risk, or we can put the limit, as you can see in the center, in the example shown in the center, we can put the limit on the level of credit demand, which means that we are ready to take all risk and obviously all the benefits of the transactions, or we can use security. This is our decision. So these are three main situations, three main options what we can do. And for that, we need actually to take 3 steps. First of all, we need to find information about the customer in order to take the decision. Then we need to analyze risk of this customer or find or analyze the credit worthiness. Then we need to structure a deal, and then we might need to do something else in order to take into account, first of all, general risk we take, and maybe take into account our previous experience. So what could be done here is we always do that either with our own credit analyst or we can outsource. When it comes down to outsourcing, or actually with the risk assessment, or with the approaches to credit risk, it's always 2 components which come simultaneously. So to solve every task, we need time. Generally speaking, working time of the people we got among our personnel or elsewhere, and we need expertise. It is quite clear that we might have best collectors in the world, but they could not be credit analysts. Opposite is also works also. So credit analysts might not be very good in collection. So only we decide what is good for our business. But in order to make credit risk assessment, we need both. And it is always our question of cost. It's always question of our workload, whether or not we would like to keep that service inside or in-house or outsource it elsewhere. Good example of that is actually credit report. Credit report, I don't need to explain the content of the credit report. I do believe most part of the audience got a clear understanding what is credit report. Yeah, if you wish, send me a request. I will send you some samples how credit reports look like. Obviously, I will send you our reports we provide. But if you look in very general, credit report contains 2 specific parts. The major one is information about the customer. If you speak with every single credit manager, especially those who work on international scale, like export credit managers, no one in nowadays just even think where to get information about the customer. Say, okay, we go to our agency and get credit report. But what is inside the credit report? And what is the actual value of the credit report? Data and analytics. So main part is that credit report is the maximum possible information about customer which your agency could collect. So when you are buying credit report, you are paying somebody to get into every possible register or source of the information which is available in this or that country. And somebody is going to check either automatically or this is physical person who does that. So when you pay for credit report, you pay for customer check. I was speaking with certain number, quite big one, of analysts who are preparing credit reports, who are doing what is called in credit report business fresh investigation. And the record, actually the actual time for preparing the credit report of a good quality is 3 hours working time. What this means? This means that you either do that yourself and save cost, like like saving cost. You save cost by not paying to somebody else for do that job, or you simply place an order and got that information. Second part of the credit report is normally smaller, but it is always automated analysis, which means that there is a formula inside, or either inside of agency database or in report or whatever. It's normally formula, which calculates credit opinion, rating, and so on and so forth. I don't want to discount the quality or whatever of this assessment, but what we need to know is that this automated analysis is nothing more than just a formula given to a computer who calculated that. So it doesn't include several important things, for instance, view of the analyst. But it works, and for some businesses, for instance, some companies who have significant number of low value transaction, this could be more than enough. This could be more than enough, and it works. In other cases where the transactions are bigger and they are of serious size, this might not be very good. But again, you know that when with the credit report, you just pay somebody for checking the customer. Again, important thing is if it is not used for credit management, or depending on your understanding of credit management. In our case, for instance, we include into credit risk compliance risk as well. So we believe it stays somewhere. So for the compliance check, this information is very valuable. Another important thing to take into account is that in some cases, information is not publicly available. There are barriers to the information. So some sources are not illegal, but they are not open to the general public. In many cases, there is a language barrier. Great example of that, China. Information in Chinese registers is publicly available. There is no issue with that, but information is only available either in Canton or Mandarin. If you know both languages, very good, or any of them, but I personally have no idea how to say a word in Chinese with except for ni hao, which means hi. So there are additional values brought by the international credit reports. Again, there are other alternatives. If you are on the local market where there are agencies, especially on more open markets, like let me give you an example, like Estonia, like Ukraine, like United Kingdom. where the information is publicly available. In United Kingdom, you can just go to company house. But at the same time, there are countries like Switzerland or United States where this information is just not available at all. And there are some other markets where you have to pay, for instance, for financial statements or some other additional information. You have to pay anyway to get that information. And very often agencies got better price. So if you are an international business and you need to check your overseas customers, credit report is a proven instrument to get information in a quite simple way. Another important topic here when we speak about credit reports is whether or not you are happy to compromise speed for quality. You see, in our current informational era, we used to believe that instant information is a benefit, and but at the same time, we need to take into account that instant information or instant availability of information, like instant credit analysis, is not necessarily of good quality. So just by logic, every product in economy could be either quick, of high quality, or inexpensive. And you can only get 2 out of 3. You cannot get something of high possible quality, inexpensive, and quick. At the same time, you see, when there are not too many businesses in the world where the time is really credit decisions are taken, where the credit decisions are taken in extremely quick way. Sometimes this is the case. For instance, in consumer credit, where consumer doesn't want to wait, or like in logistics, in logistics business or in transport business, where deals are made in quite quick way. Companies need information instantly. But again, logistics business is a business with a big number of low value transactions. When the transaction is of higher value, the decisions are not taken that often. So in very general, we are not reviewing credit limit every 15 minutes for the customer. No, this should not happen, at least. We are taking several decisions over the year, and we can prepare for that in advance. So information should not be quick or extremely quick. Information is to be timely. So it must be available when we take a decision or when we make an analysis. So we have much more time than we normally believe. We just need to prepare for that. And we don't need to compromise quality for time. We just need to place an order in advance. That's my view on that. And as I said, international credit report, by definition of product, by definition of business model, provides us with automated credit analysis. In some situations, this is enough. In some situations, we need to take data from the credit report and either analyze ourselves if we personally, being a credit decision maker, got that capacity, or give this information to a credit analyst who will make an important stage. Actually provide a conclusion. Obviously, so why we need creditworthiness analysis from the credit analyst? In my whole career as a credit director, I used to say to my colleagues that Excel or calculator or somebody else should calculate. So calculation is to be done by machines. One, my drastic colleague, quite known credit manager, used to say even monkey can calculate ratios. The main part of the job of a credit analyst is actually synthesize these calculations and provide qualified conclusion, meaning somebody who will explain why creditworthiness is so. Pretty simple example. I gave it, about 1,000 times so far. If you hire either me or somebody even of higher qualification than myself, you can even hire, I don't know, Edward Altman as your credit analyst. By the way, Edward Altman will be with us on the coming event. So this is just like a bit of announcement. So even if you hire credit, Edward Altman, famous scientist in credit risk area, and ask him how much money we can safely trust to this company, and Edward Altman says 1 million. Your first and a very natural question will be, why 1 million? Why it is not 900,000, or why it is not 1.5 million? Because you will compare that with the credit demand of the transaction, and you need to know why the credit worthiness is so. To me, this is natural. Please correct me if I'm wrong, put that in the comments. But majority of decision makers I spoke myself simply say, no, we cannot trust if there is no explanation. Like in the famous movie about space program, American space program, Scott Glenn says, you cannot trust somebody whom you cannot look into eyes. So there is no trust in that. It's difficult to rely. Although, mathematically, this might not be necessary. But when you, as a decision maker, set a task to credit analyst, you receive his or her job, and then you have a look, and then you ask questions. So you need credit analyst. So credit analysis could be done in-house, or it could be outsourced. We do that. If you need to know details, please give me a call. But the main idea is that you need somebody who will analyze financial statements, take into account all other necessary information, like trends you can see on the picture and more. That would be also qualified information. And based on the methodology, either approved by you or agreed with you, or the one you rely on, will just make an analysis and provide you with the assessment of credit worthiness and the explanation. The credit analysis, the most part is this qualified conclusion, an explanation why the credit worthiness is so, without which we can just not rely on that assessment. So quite simple thing, why credit worthiness assessment is done this or this specific way. Again, this could be done by you in-house, or this could be done by your outsourcing partner, depending again on two issues. As we said before, if you have time, or if you have capacity in terms of working time, and you have capacity in terms of expertise. I can give you an example of the way it works. In our practice, we have a customer where an entity has about 25 customers, and they got only treasury manager who takes care of the whole treasury of all customers, and already works about 10 to 12 hours a day, including weekend. At the same time, they have a requirement from their headquarters to analyze every customer once a year, to make sure they are ready for sound, for this credit worthiness is ready for sound credit decision making. but at the same time, 25 customers. To analyze a customer, this is, I mean, for credit report, this is 3 hours. And then you need another 2, 3, 4, maybe sometimes even 5 hours to analyze a customer, just to make a creditworthiness analysis. And if you multiply that by 25, this would mean this would be at least 75 hours of working time only. We skip expertise. Just to analyze this customer, plus minus 2 weeks, and this person doesn't have these 2 weeks because this person already works, I mean, more than it is okay. Let's put it this way. So outsourcing in this case is quite simple solution. They are sending us, by the way, credit reports from other company. We got financials from there. We do credit analysis and provide them a white label analysis based on the methodology they approved, and then they are structuring. They prepare their credit request and send that to their headquarters. Everyone's happy. And especially taking into account that credit analysis is done on fixed fee basis, so you don't pay for the credit analyst who is sitting in the office, spends resources being an in-house employee. They just pay for the job done. Quite simple, quite clear. Another example of credit analysis is when you need a second opinion. Sometimes the expertise or qualification of credit analyst is not very good, or you need something deeper. Again, you give a call to your outsourcing partner, send data, and you got analysis or like deeper analysis or whatever it is. As simple as it is just said. Quite similar to credit report, but the difference is it is not automated decision, because for serious decisions you need really a credit analyst who look deeper in details and synthesizes that qualified conclusion of a credit analyst. Another example of outsourcing, or the task, is actually the next stage. As I said, next stage of credit management, as I said, credit analysis is not a decision. It is not dictating decision. But it must be incorporated into the trade credit structure, meaning that you need somebody either within your company or outside who makes who actually retranslates risk assessment and other information into the at least three main terms of credit, which means payment term, credit limit, and security requirement. For that, this is a little bit bigger picture for the customer. And if we, some companies like, there is a research from Swiss Credit Management Association. This research found that about 45% of companies in Switzerland provide extend credit terms without having no idea about the credit worthiness or financial stance of their customers. This is sad true. So credit analysis could be skipped, but also nobody said that if customers' credit worthiness is 0, we should not provide customer with a credit, or we should not work with customer at all. So inevitable task is finding terms of credit, whatever credit worthiness is, or honestly, or be more precise, which means that we need to find credit terms which would be adequate to customers' business, to our business, and to the market. So structuring or finding optimal terms is a task which is inevitable. We have to do that because we cannot simply provide customer with our product and then rely that they will pay sometime. I've seen, this is also possible. This is also possible, but it would never deliver results you believe it is correct, or the results you want. So you also need, and this is actually main job of the credit manager, this is an art, to find first of all, find optimal payment term. Customer asks for 60, and then it's a question, it's a job of credit manager to ask why 60, because we find it is 45. Credit payment term, to my understanding, and to the, based on my experience, payment term is as important as credit worthiness, sometimes even more important. So it's quite simple idea. We take credit worthiness, we find optimal payment term, or as you can see on bottom left picture, it could be a corridor, a range of optimal credit terms, which we use to negotiate with customer. We can take into account, you can see on bottom right, payment performance. And then we do, this in the center might look complicated, but generally speaking, we simply take available information about the security, about the creditworthiness, about sales. So we put all the necessary information on the picture and then decide how much risk we can take or we will take, and actually decide what limit to set and whether or not we need security. This could be done in-house, subject to two components we discussed above: time and expertise. Or you can simply come to outsourcing partner like us and ask them, can you please help us to structure a deal with this or that customer? Obviously, when you have a credit policy, when you got everything prescribed and you already have experience, this is not necessary. But sometimes, again, as a matter of second opinion, or in export transactions, for instance, again, linked to my experience, I had 300 customers, and most of them were signed as one country, one customer. So every single customer supposed to have their own credit policy to deal with that. So again, this is structuring and restructuring. Question: who is doing credit management, and whether or not you got clear idea when you take a decision, whether or not you got clear idea what are the optimal terms, because you might simply provide customer, I don't know, 120 days payment term just because customer asks for that, which would mean significantly higher accounts receivable, outstanding balance, which might mean also we don't know the financial stance. You don't know their financial stance, so this quite high probability of higher risk exposure. So you're taking more risk. You need more resources to finance that just because you provide customer with terms they request. Or we might provide you with arguments to reduce that. Or we can turn it. For instance, if you are in a buying position, so when you negotiate credit terms with your supplier, and supplier is not happy to provide you with the credit term, the same approach, because granting credit and taking credit works on the same rules. It's not similar rules. These are the same rules, just different positions. So when you switch your position, you can use the same approach and you can use the same service to find arguments to convince your supplier to provide you with either longer payment terms or better terms of credit, or providing credit if you got a supplier who insists on the cash in advance. This could also be the case, and again, this is available on fixed fee basis with credit engineering. Simply give us a call. And before we go further, we need to speak, how can we do that? I need to mention that there are two levels of credit management. First level, is very important. These are three stages we discussed before, is actually the stages where we consider transaction just between two companies. But at the same time, very often it's quite exceptional, honestly, when the company has only one customer and one supplier. Normally, we have numerous customers and suppliers, and we are speaking already about the portfolio. So my personal approach to portfolio management came once, so this was something like 20-something years ago. I was working with extremely visionary CFO. And once I came to him with the recommendation of credit decision, and he asked me, do you know if, first of all, tell me if this decision will be, provided that it will be taken the way you recommend, will this decision increase or decrease our risk exposure? I said, yes, it will increase our exposure. So I recommend to take some more additional risk because of 1, 2, 3, 4, 5 reasons. But then he asked me, and do you know how much risk we already take? Obviously, I didn't have an answer, but that was the triggering point for me to, first of all, find the methodology. How can we see the exposure on the portfolio level? And then how can we manage that? And this led me to significantly to an interesting conclusion that coming back to the diagram on, to the stages of credit management, I found a bit, because I passed through that way myself, that normally when companies tackle credit management, they start with collecting overdue. Then companies understand that mere collection is an endless job, because you collect, then customer don't pay on time next time, and then you have to collect it again and again and again, and this is an endless job. So you need, generally speaking, good collection is actually a way to make customers paying on time, but this won't work without control. So from collection, we move to control. And then on the stage of control, we understand that it is too easy to improve receivables at cost of sales, but this is not a good job for the business. Obviously, we can cut sales, which are we don't want to discuss now. We all know why sales are growing by the end of the month, quarter, especially on the end of the year. But at the same time, we anyway need to control. But that way, we can control, but improving receivables at the cost of sales is not a good job for the business. Credit exists to finance sales, to finance companies' competitiveness. So mere control doesn't work. So before we start controlling, I never said the control and collection are necessary stages. They are important stages, but before we start controlling and collecting, we need to make sure that our terms are adequate, our terms are optimal. Otherwise, we can do too many mistakes. So then companies start to structure, then experience structure, to experience with structuring every deals, lead companies to write credit policies, and at the same time we are coming to the portfolio view. So we are coming to the question which my CFO asked me that time. So how much credit risk we take? What is our portfolio performance? What is our portfolio at all? Do we know our portfolio as well as do we have enough knowledge about our credit portfolio? That's an important question. So then companies start to build to build their portfolio analysis approaches. They discover that, and they face what I faced myself, that having even simplest portfolio methodology, portfolio analysis methodology. You have holistic view on your accounts receivable, and you understand that because that was one of the biggest discoveries in my professional life. When you look at the portfolio in a holistic way, you can see so many things, how to improve credit management. And one sad thing is that if you start with portfolio analytics, you can do that improvement or like optimization of credit management at least 2 times faster and, times cheaper than if you start with collection. Where the companies normally start portfolio analytics. Obviously, this could not be done with a piece of paper, pencil, and calculator. It doesn't work. You need databases, and you need some, data integration. So when we speak about data integration, you need to take, on the left side, you can see internal data, then external data, you combine them, you integrate them, and you got your portfolio view. Very often, this could come with either ERP implementation or implementation of specialized credit management software. Both projects are significant, are big, and both types of projects are expensive. And very often, sometimes I've seen a couple of examples, at least, where the companies spend, tens of thousands of euros or dollars. Sometimes this is go to 100 and higher, just to see their portfolio exposure. And at the same time, their top management and their managers had really wanted, we were eager to see the portfolio exposure. How does it look like? How does it work? Just before you implement them. And that's why there is a demand. It's not that big, but we got that product, and we provide some companies with the portfolio analytics. Like we do data integration, we simply take the data, internal, external, we do data integration and provide companies with the portfolio view they need to take their decisions on much more global scale. For instance, to see what is their portfolio exposure and what is where their capital. So if what would happen if all the credit risk they take would materialize, whether or not they will still be solvent, and so on and so forth. Actually, portfolio analysis is not a formalized, like data engineering. It's a creative work, because we need every company gets its own situation, and the process of portfolio analysis is to be somewhere on the level of managerial accounting, on FP&A basis. So we need to see how much credit risk we take, what is our payment performance, what are our credit terms. Also, this might include calculation of what we call comprehensive credit cost. So how much this portfolio costs our business. There are seven big components. We were doing masterclass on that, like on comprehensive credit cost. So yes, we can calculate that as a part of portfolio analysis as well. And what is more important is that, when people see, or when people think about portfolio analysis, they start thinking about number of tables. In reality, it's not a specific number of tables, or not even the dashboard. Based on our experience working on serving CFOs and financial managers and businesses, let me turn it a bit different way. When you set a task to your credit analyst to do portfolio analysis, you are not asking for the table or number of tables, or please provide me with 1, 2, 3, 4, 5 tables. You are asking for a deck. You are asking for a deck where there will be tables, there will be graphs, and there will be an explanation what's going on with portfolio and how this, if it is an issue, could be resolved. So in very general terms, you need a process which helps you to see areas for optimization within your portfolio. Because when you got that, that's why we call it not portfolio analysis, but actually portfolio presentation, because we, based on requests from our customers, we provide them with decks, with a ready-made presentation which they can use to discuss in credit department or in finance department internally, or get together with sales and general management and discuss the status of their portfolio. And here you can see examples like portfolio exposure, or you can see exposure by customer. Agents like to see the structure of overdue, and more specifically, payment performance by every customer. So you can see who is paying earlier, who is paying later. Again, it's question of it's already question of cooperation between the two parties, because generally what we do, companies or company personnel do know their business, and we got credit management, and we got we got an expertise in implementation of that portfolio management. So we combine the two and get a final product, which, and this is like, portfolio is complicated thing, because just to say simple, in order to see portfolio exposure, you need to analyze credit worthiness of every customer in your portfolio, which is quite a complicated thing. So it's not coming with a mere automation, but the process could be built. This could be one of the tasks, and then you might outsource it to somebody who will be preparing that, working as your internal credit analyst, set a task to a credit analyst, or you can outsource it to somebody who will be doing that, depending on the cost and depending on the expertise availability. What I can say here is that expertise is available, then the price is or the cost is discussable. Important thing to mention here: you don't need to wait until you will be implementing ERP, or updating ERP in your company, or you don't need to start quite big process of implementation of the specialized credit management software. And by the way, we made in one of our polls shown that most part of companies really want to see the automated credit management not in a specialized piece of software, but within the ERP. Again, in order to put it into the ERP, you need to have a process explained. You need to have a process which you believe serving your needs. So this is where it is done. ERP is for business. The business is not for ERP. So you need to have clear idea what portfolio analytics do you want to see. Then it's a question of tools to use and who will be doing that. Again, this could be done. I never seen ERP system who is producing decks, but our customers really order that portfolio analysis. Sometimes we just prepare the, let's call it, graphs and tables. Sometimes we provide our conclusions on each and every stage. Funniest example of portfolio analysis is our customer who is saying that they are ordering portfolio analysis once a quarter, and the person who is actually the user of that information once said that he's going to present that portfolio situation on quarter basis, every quarter, with general management, finance, and sales. And once he gave us a compliment saying that, I've opened that presentation you sent me last week, 15 minutes before the meeting, and I was presenting like naturally because I knew the structure. It was done exactly in the way I was expecting. So I was absolutely clear to see with all the analytics, everything was done in the way I expected, and it was suitable for us. And much more important, portfolio analysis and the process I explained, because I mean, portfolio analysis is just a tool, but when you got in your company, when you got a process where you regularly review the status of your portfolio by all the involved stakeholders, like general management, sales, finance, maybe treasury, maybe customer service, maybe somebody else, whoever, you already got their contribution, you already got general ongoing discussion. And this facilitates improvement and optimization of your portfolio, which is quite important. That's more or less everything I wanted to say about the portfolio analytics. Again, this could be done, and you can have it much more faster. The main idea is much more faster than you start to implement that in your ERP system, or you start the ERP system at all. One important rule of thumb, which I mentioned in the beginning of my today's presentation, you see, there is quite a simple thing. You can outsource reasonably any task, depending on the trust you put in your outsourcing partner, depending on the depending on your budget, depending on your general policy. I know a couple of companies who simply, as a matter of policy, as a matter of principle, take everything in-house, including the cantina and including the restaurant, everything. This is also a decision, but you cannot outsource decision-making. You cannot let anyone decide on your behalf. Maybe within the company, when manager delegates to his or her subordinate some managerial tasks as a matter of management development, this could work. But as example, if you just rely on the credit limits set by your factoring or set by your credit insurers, you put yourself in a quite difficult situation, because if you need to go above, that's just an example. In some situations, this could be the case. For instance, if you have a very exclusive product and you can dictate credit terms and you don't need to compete because you know you've got a hyper demand, on your product, this could be the case. This could be the case, but this situation is actually a luxury for maximum 25% of businesses around the globe. In all the rest of cases, you have to compete. You have to compete, and this means that you need to provide some flexibility. You cannot just rely on the limits provided by third-party partner. This is not the limit, just a credit opinion. This is the money, this is the risk the insurance company or factoring company is ready to take. But if we go a bit deeper, their business model is different from yours. They are not competing on your market. They are not doing business with you, although they are doing an extremely good job. But their main kin, the main kin of finance providers or trade credit providers, is actually the collectability of that debt, because their margin is very low. And actually, we are asking them to take our credit risk, obviously at a quite tiny fee, if we compare that to the amount of exposure. So their idea is to get it collectible, because their business is to take our risk, not to sell on our behalf. And in vast majority of businesses, we need to provide flexible, because we need to be competitive. So decision could not be outsourced naturally. just, if you wish to skip everything I just said above, in simple terms, the decision making capacity comes with responsibility, and neither outsourcing partner could be responsible for the decision. And this is our policy as well. And we, every time we discuss an outsourcing, I say, with due respect, we can be responsible for what we are responsible, but we never comment and we never take decisions on your behalf, because decision could not be outsourced to somebody unless you're happy to provide a responsibility. In case of, again, in case of factoring or in case of credit insurance, this is also a responsibility because they pay for that. But that responsibility is always restricted. Sorry if I am too detailed. If you want to know more, if you really want to discuss what is available, please, here are my contact details. You will have this presentation. You will have the copy of this presentation, and you will have the record of this presentation, everyone who registered it, or just register if you didn't do that before. So you will have that email with all the details. And please don't hesitate to send your request, and we will be happy to discuss what can we do for you, for your business, in order to, in general, credit management provides two things: helps to sell as much as it is possible and to lose something close to zero. I've shared nearly everything I wanted to share. So, and we are getting to Q&A session. I do believe, please, if you didn't do that before, please put your questions in comments, and I am happy to answer them. So let me check my phone. Do we have questions? Comment from Michael Dennis: as companies increasingly seek to outsource credit risk management functions to third-party providers, they face the dilemma of finding vendors that offer comprehensive risk assessment capabilities consistent with their expectations and requirement, while also be cost efficient. Michael, if you know such a companies, you already got my contact details. We would be happy to discuss, and we will be happy to discuss. And I do believe we provide something really cost effective in terms of analysis, and especially when it comes down to portfolio analysis. Okay. Brett, yes. This was my Chris. I mean, you are getting His Lordship Professor Altman. I still don't believe in my happiness. This was my reasonably Christmas gift, because Edward Altman responded to my email written somewhere in the summer, just like the 27th of December. So please don't miss this opportunity. Professor Altman and Dr. Sabato will be on our air on April 4th. Don't forget to register, because then if you miss, you will receive a record of that. Otherwise, again, please subscribe to our YouTube channel. The record of that event will be on our YouTube channel. Good comment. Payment allocation and credit reports can be automated. Yes, this could be automated, but then it's a question how much time we spend on to correct mistakes with that automation. And counterintuitively, again, based on my experience, you might have your own, and we can discuss this, but automated reports could not so far, especially when we speak about international basis, automation does not necessarily provide that level of quality which could be delivered by live but by a physical person who is double checking the computer. This could be the case when we are on the local market, but taking into account that we have 250 something, 56 if I'm not mistaken, countries on the globe, and each of them got their language barriers, different levels of availability, and so on and so forth. Automation, like instant like this, still, I would say, either dream or yet to come. Therefore, even in our case, when it is necessary, will the reports, when it comes down to international, when you go to countries with quite open data, or data availability, again, Estonia is a good example. United Kingdom is a good example, but at the same time, it's not the luxury of developed countries only, because when you look at United States, when you look at Switzerland, I mean, United States and Switzerland are the two main examples of the most closed countries in terms of company information. Significant part of information is really not available. And we have to take, but nevertheless, we have to take decisions. Again, it is yet to come, and it is still your dream. So when we look at one country, this does not automatically mean that in the neighboring country or in other country we will have the same data availability. It doesn't work, and this is the trick of export-import business. So these are these are all questions I can see so far, questions, comments, and thank you, John. Thank you very much for coming, and I always appreciate when you come. There is a comment from Andrea. There are specific privacy policy agreement between parties. In Italy, for example, we need a policy license to operate as business information providers. This could be the case. This could be the case because every single country on the globe got its own legislation, and well, it's not like, China is as different from Europe as I don't know, like we live on different planets, and doing business with other country is really a complicated issue. You see, in my life, I entered export operations in something like 20 years ago. And I can tell you one thing I caught immediately is that when you, in your profession, when you move from local domestic operations to export, you need to multiply complications at least by 10, if not more, because even if you have only one border, if people in this country speak the same language, so they speak the same language, it's already different country with a different legislation. different cultural differences, different legal, and customs of doing business, and so on, and so forth. So it's never easy and will never be easy. Again, your decision how to do that. I will take a bit of pause, and please, if you have further questions, most relevant or most recent, yes, maybe we are missing questions. Let me do one more thing. Let me try to see it. Let me do one more thing. Okay. So, ladies and gentlemen, so payments. That's credit management experience. Thank you very much for being with me. Thank you very much for your passionate attention to our humble work, and I look forward to seeing every one of you on our coming events. Let me make just two announcements as we have a little bit of time. First announcement will be dedicated to our new series, if you wish, because we start the program which will be called Credit In. So let me announce it a little bit. So this will be an international credit management voyage or travel or trip, where we will be discovering the specialities of doing credit management in different specific countries. So this would look like an interview or discussion over a pint, to be more precise, with a credit manager who has substantial local experience in the country. Our first issue will be in Ireland. I mean, as I mentioned, discussion over a pint, and we will have an amazing credit manager. Most of you know him because he was with us in credit chats. This will be Declan Flood. So we will be discussing doing credit management in Ireland. Another event, which was already mentioned by the great one and only Brad Morris. Yes, we will have His Lordship Edward Altman and Dr. Gabriele Sabato. Dr. Sabato, they will join us on April 4th in the rubric which we call Credit Science. So this time I will for sure be very far from the smartest person in the room. I could not call myself even smart. It's such a been surrounded by yes, Professor Altman, absolutely, Brad. So I am very happy, a bit scared because I need to prepare myself very, 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 very seriously to ask, not to ask stupid questions, but I will have two doctors of credit risk, and we will have an interesting discussion about the development of credit management science. And the main topic will be on small and medium-sized enterprises. So please don't miss this. Register for the event. You will have everyone who registered will receive an invitation in you will have an invitation in the email which I will send to everyone with record of this event and with all the materials. So yes, this event is coming, and I am looking forward to seeing all of you on it. Thank you very much for today. And in a traditional way, let me wish every one of you highest possible sales, lowest possible losses, or the way it could be said in the area where I live, in French, this could be said, bon crédit. Thank you very much and see you soon.